Welcome to Property Power Talks, the exclusive podcast for NB Property Law. I'm your host, Kayleigh Swift, and each episode will dive into cutting-edge insights on property law, probate, estate planning strategies, and seamless estate administration. Whether you're a property investor, homeowner, industry professional, planning your estate, or wanting to understand how estate administrations work, then our expert discussions will empower you with the knowledge you need to navigate the complexities of property and estate planning law with confidence. Let's unlock the power of property and estate planning law together. Good morning, everyone. Thank you for joining us today. My name's Kayleigh Swift, and we've got Robert Rey here from CPRM. So a little bit about us here at NB Property Law. So we're part of a broader law firm known as NB Law Group. We have a employment, migration and commercial law divisions as well. And I'm the director here at NB Property Law. So we take care of all the property and estate planning matters. We offer a personalised proactive advice to our clients to help them minimise the risk and take the stress out of their next property transaction or estate planning matter. We're more than just a team of legal experts. We're dedicated problem solvers, committed to creating personalised solutions to guide our clients and help them find a way forward. We do everything from residential, commercial, property law transactions, and we're here to help our clients find clarity and help them proceed and find the guidance that they need. Now, I'll hand over to you, Rob, to let you introduce yourself and CPRM.
Thanks, Kayleigh. Robert Rey from CPRM Property Group. We basically handle everything from commercial sales and leasing through to residential, property, high-end business sales, project development, construction, migration and investment, and also an asset management division where we look after both residential and commercial properties for owners as well. So I've been in the game now probably 26, 27 years and spent a large number of those years with Rey White Commercial as well. Actually started when Rey White Commercial first started in Queensland. So, we pretty well handle everything. We do specialise, we kind of like specialise for people. We tailor things to basically assist them in helping. We do a lot of due diligence for people as well when they're buying buildings. So we pretty well do anything with property, that's what we do.
Wonderful, thank you. So what we're going to cover off on today is we're going to go through what the current market conditions and trends are. We're going to go through the different types of clauses that we're seeing that are being introduced to leases. We'll talk a bit about what the Brisbane market and major developments that are happening and some urban planning changes that we can expect to see over the coming years. We'll go through what impact change in actual government has on effect on property laws. Robert will speak to us about some in the investment market and what the yields currently are doing, and also the purpose of lease incentive deeds and how they will operate. So to start us off with, we're going to talk about the current market conditions and the trends, and I'll hand over to you, Robert, to take us through that one.
Well, basically in trends, we've got a number of different areas in the property market, everything from office, retail, medical, industrial, through to restaurants, if you break it down into certain areas. And each market will probably change in a different way. And obviously, we all know what happened during COVID. We don't need to talk about that again, and we don't want to talk about it ever again. But if we start off with the office rates, for instance, they were decimated during COVID because everyone worked from home. So there was vacancies everywhere. And it took a little while to come back. Probably last year, we started to see, strong levels of buildings being leased. And then probably about middle of this year, we started to see a lot drop off again, and then it's starting to fill up again. So the office market will go up and down. It really will. It changes, and it's a very volatile market depending on the needs. Retail is an interesting area as well, and it's just really been in a slow decline since COVID. Obviously, COVID decimated retail. And then also the big thing is online marketing and online purchasing. Now a lot of people can sit at home and purchase stuff over the internet, have it delivered in 1 or 2 days. So you find retailers, you've still got your major retailers out there, but it's difficult. And we're seeing retail kind of like dropping off, quite a bit. We move on to our next area, medical. Now, this is an area that's just gone crazy. Obviously, we're an aging community and people are living longer. And therefore the need for medical services. We're always short of doctors, staff and everything like that. Over the last few years, probably 4 to 5 years, we've seen a lot more bigger medical centres go up, these medical centres which incorporate, radiology, physiology, all the allied health and everything like that. It's basically your one-stop shop. It's a bit like actually a service station. You used to go in and get fuel. Now you can go and get milk, chocolate, bread. You can pretty well get anything. It's pretty well the same in medical now. You go into some of these centres and you just go from one section to another. So what we've seen there, we've seen the yields move a lot, and we've seen medical really grow. A lot of medical centres have gone up over the last few years. Industrial is another massive mover. I remember years ago from the late 90s, early 2000s, industrial just didn't do anything for years. You know, a basic industrial shed on the north side would be, you know, at $95 a square metre, $95 a square metre. 10, 14 years later, it's at the same rate. So it never really moved. All of a sudden in the last 4 to 5 years, obviously industrial's changed a lot in how it's built, but we've seen rates go up drastically, probably 50, 60%. And that's affected the yields too. People are racing to buy industrial now because they believe it's secure. I think it's overinflated myself. I think some of the rates are getting up very, very, very high, and it's kind of like not sustainable. So how's this affected sales and leasing rates? Well, we kind of like pretty well talked briefly on that when we did it. You know, like medical have gone up and up and up and up, basically because of demand. It's the old thing, supply and demand. Supply's short and demand's there, and as the demand keeps rising, the rates are going to keep going up. And obviously, we've seen the same with industrial, as we talked about before. Those rates just kept going up and up and up because really in the last few years, the number of industrial parks, we had a period there in 06 through to about 13 where we were building them like crazy on the north and south side. And when the land started diminishing, not as many industrial sheds going up, the supply was starting to get short. So when you get short supply, that's what pushes the prices up.
Awesome. Thanks for that, Rob. I suppose from a leasing perspective now, you know, we're going to talk about a bit about what different clauses we're seeing introduced by leases with tenants. So I think the main one that we're seeing come across a bit is the force majeure clauses. So a lot of the times now after COVID, tenants trying to make them more general, while obviously the landlords are seeking to close them out a bit and restrict when they can actually be relied on. So, you know, things such as a COVID outbreak or something similar would not be covered still under the force majeure clause, whereas tenants are trying to make that basically part of a force majeure clause. The other one is allowing more flexibility to current tenants to sublease. So we've got a new Property Law Act, which was basically given royal assent on back in 2023, the end of 2023. However, this is not going to come into play and have a start date until August of 2025. With this new Property Law Act, though, it's going to ensure that if the tenant requests consent to actually assign or sublease or change the permitted use and any other alterations that require the landlord's consent, the landlord will have 1 month from receiving the necessary documentation of notice to make a decision on that. So the parties will basically have to agree to an extension of the date for the decision notice if it needs to basically extended beyond that 1 month period. The decision notice that's given must state the consent conditions that have been given by the landlord for approval. And if the consent is actually refused by the landlord, it must also state what are the actual reasons why the landlord has refused to basically either consent to the assignment, the sublease, or the permitted use under the current lease. The other thing that we're seeing change quite a bit is the focus on fixed rent increases. So a lot of tenants are wanting to go with a fixed rent increase, you know, to probably allow more, so they know from a certainty what their increase is going to be each year, as opposed to like a CPI increase. Probably the main things that we're seeing at the moment in terms of lease clauses and what they're doing. So we'll move on now to what the Brisbane property commercial market's doing and what major developments we have coming up and some urban planning changes over the coming years that we're going to see. So I'll hand over to you to start with this one, Rob.
Well, obviously, as our market's growing in certain areas, we're seeing obviously that growth from the city out. Many years ago, the north side had that massive growth spurt, you know, in 06 through to about 13, 14. We all thought around 13, 14, well, it's got to slow up out there. Well, it doesn't. They've got that much land out there. It just keeps going crazy. And I think from a north side perspective, the north was it just doesn't stop really. It just keeps going and going. And what we've seen lately too is probably the south. is doing the same thing. It's actually pushing down to the Gold Coast and pushing out to the west. So from industrial areas, you've got areas like Crestmead, Willawong, all those areas out there now that we're seeing major national and international companies actually putting their base out there. And when they start putting their base out there, others start to follow. So we're really seeing Brisbane stretch and broaden. In the past, we had the city, and then we had those little areas that were kind of like little infill, and then you went out to your major development areas. Well, everything's kind of like filling in. It won't be long, as I think they said years ago, when we see that fill in from the Gold Coast to Brisbane. Well, you can start to see it now. I can't believe how areas like Shayla Park, Park Ridge, they're just going crazy. In the inner city area too, it's still growing. There's infill areas that are getting filled up. Older buildings getting knocked down, newer buildings getting put up. This growth, where will it stop? I suppose Queensland is a state that's growing rapidly. So as it continues to grow, the need for services, the need for small business, it just keeps growing and growing. And as I said earlier, those rates, sale rates and leasing rates are starting to get there. They're really starting to get right up there. I'm a bit worried that, like what happened in 2008 with the GFC, we all thought that, nothing would ever happen. But I always like to say whatever goes up must come down. And it's really healthy for the market. Like, it's healthy for the property market to have those ups and downs and peaks and troughs. If you don't have them, you end up having too high a peak, and they say too high a peak, too low a trough.
What effect then do you think the Olympics are going to have on our Southeast Queensland development pipeline?
Well, obviously, we've started to see it. Restaurants have been struggling over the last few years since COVID. They had that big burst after COVID when people couldn't go out. But then I think a lot opened up, and then we're starting to see restaurants struggle a lot. But we're still starting to see more of them come up. And I think you look at what's happened with it's just gone crazy with the amount of restaurants in there, and people still go there. I think as the Olympics, we'll see just tighter infill in towards the city. And obviously, we're seeing more and more units go up, and we're seeing that in unit prices rising, which is extraordinary. Unit prices generally don't really go up to the degree that we're seeing now. And I think that's just basically because of the amount of stock that's pushing through. But will the Olympics? I don't know. Everyone has a different story on that. I think after the Sydney Olympics, everyone thought that it was going to be fantastic afterwards. But then they had that big lull afterwards. Same with the Commonwealth Games down the Gold Coast. Look, I think the Olympics are great for our infrastructure, and it needs to happen in Brisbane, because the congestion around Brisbane, I just come back from 2 weeks in China. So the congestion over there is so when you come back here, we really haven't got congestion. But I think that the Olympics will bring a lot better services into Brisbane and kind of like put it more on an international stage. So therefore, we're going to compare with Sydney and Melbourne a lot more. And that's then going to drive more and more businesses to Brisbane because the services are here for them.
Yeah, wonderful. I think the infrastructure is definitely what we need here, though. I think we're a bit behind with trying to get that in place. So I think that'll definitely help us with the growth in the actual property market. In terms of, obviously, we've had a new state government put in place and potentially a new federal government soon. So what changes then do we see with new governments when they come into place, and what are the proposals and the current laws in terms of government? So currently the new government, have made several promises prior to the election, including that they're going to abolish stamp duty for all new home buyers and first home buyers. They have obviously raised the stamp duty concession threshold for existing homes to $700,000. They've introduced the Boost to Buy scheme as well, basically allowing the federal government on 27th of November this year allowed the bill to be passed so that the government will basically have a 30% share in home buyers' properties, residential properties. But in terms of that, so a home buyer will only need to have as little as 2% deposit to purchase a home. Essentially, though, with this Boost to Buy government scheme, it means that the government will then own 30% of the property. So when that property gets sold, they're going to have a 30% share in the profit of the property as well. That's going to need to be paid back upon sale. The other thing that's being promised by the new government is the plan to build 1 million extra houses by 2044. And make new regional plans and fast track approvals for them. They've also spoke about removing restrictions and preventing first home buyers, grant recipients from renting out rooms and opening them up to the rental supply. So now first home buyers can actually rent out rooms in their properties without being in default of the first home buyer grant. They've established to build 10,000 new social and community homes on church and charity owned land to unleash some of the community housing sector and also clear the targets to ramp up the social housing. And they've also fast-tracked development approvals for safeguarding the materials and the tradies needed to build the homes for Queensland's future, given the housing crisis. So at this stage, the LNP hasn't actually introduced any bills relating to any of these promises, though. The previous Labor government made the change regarding the stamp duty threshold, so that one is currently in place. But the LNP announced that they would do it when they got into power. We'll see. It's unlikely this will be changed, though. The boost to buy will work with the federal government's new Help to Buy scheme that I was speaking about before, that's been recently passed. So there's no real start date, though, that's been set in place for that scheme. It's been approved, the bill's been passed, but we don't have a start date. We'd expect hopefully some date next year, but at this time we're still unknown as to when that will be. So now talking about property yields, where have we seen them move in each of the markets, Rob, over the last 12 months or so?
My favourite topic, love yields. I love discussing them because it's very, very interesting. A lot of people really don't understand yield. It's funny, you talk to people and you ask them about yield. Yeah, the return on that. Everyone gets confused with return and yield. And I say to everyone now, they're two different things. And a simple way to think about it, you buy on a return and sell on a yield. If you think of those two things, you can't go wrong, but they are two different. And there's only one time that both are the same. There's only one time in a property's life cycle. And of course, that's when you purchase the property. So when you purchase the property, you buy it on a 6% yield, you now have a 6% return. But that will change as things go up and annual increases and so on. But retail, yeah, look, we've seen retail used to be fairly strong, but we've seen retail now sneak up a little bit. Basically, as I said before about retail, it's diminishing. So therefore, obviously, if retailers are struggling and struggling with business, and we're seeing more and more vacant shops everywhere, it's got to affect the yield. So we're seeing that. Look, I see around the 6.5s around that area there for something good. Office, much the same, very fluctuating. An office, people change offices. These days, people might be in office for 4 or 5 years and they want to downsize, upsize. So therefore, offices might become vacant, probably a lot quicker. So I think office yields, 7, sometimes a little bit higher, I think. Medical, strong. Some of these big national tenants, we're seeing 5, 8-year, 10-year leases on medical buildings. Because it's so strong, you're not going to lose a medical tenant. They're going to stay there for a long time. And the infrastructure that needs to go into some of these centres too, like some of the fit outs are, millions of dollars. So therefore a medical tenant isn't going to move. So we're seeing them, still around the 5s, probably a couple of years ago, they were sitting around the 4s, just over the 4. There we go, industrial, the same sort of thing. Years ago, industrial was right up there, 8 or 9%. And even I remember it was at 10 and 12%. Industrial, people just didn't want to buy it, basically because they thought it's too risky. Tenant's only there for 1 to 2 years. You lose the tenant, you're going to have a 6 or 12-month vacancy before you can find another one. So really, these yields will depend on a number of things. Obviously, the yields depends on the market. It depends on the vacancy rate, stock in the area, and obviously the quality of the unit as well. Industrial, we're seeing that these little SMFS funds, little super funds are 500,000-700,000. They're happy to buy them at 5.5% because they sit in the super fund and they're great. They just sit and forget.
How about we've got the restaurant and food industries as well. Service station.
Restaurant the same, struggling, 6.5s to 7s. But then you've got your majors, your KFC, GYG, McDonald's, all of them. We're seeing sub 5s. And basically because of the length of the leases, just in a KFC lease now, which is around, 15-year lease, people buy them and they set and forget. And over years, the increases are going to slowly get you, your 4.5s. Eventually, after 15 years, you're going to be sitting up, around 7%, 8%. Service stations, again, many years ago, service stations used to be the worst. No one wanted them. They were 12, 14%. Now service stations, because they become so popular, and the service stations sell a lot more. They sometimes have retail. They sometimes have foodies in with them. We're seeing them 4.5% to 5%. We're people lined up to buy service stations. And then we look at childcare. Well, childcare, I don't need to say no more. There's not enough of them. They seem to fill up all the time, and they're a set and forget 10, 15-year leases. People love buying them and letting them sit there and grow. So we're seeing the 4.5s to 5s sitting in that childcare range. They're good quality ones as well.
Awesome, thanks for that. So that's a bit of a good overview then of where the property yields are currently at. So then moving on a bit, where do you think we're going to see the yields moving over the next 6 to 12 months in each of these sectors?
I love these discussions. I was wrong last year. I thought in 2023 we'd have a bit of a dip, but the market has held on and held on and held on. And I think we've been fairly resilient. But we talk about, the government, the debt's rising. Interest rates, we've been on hold for quite some time now, but look, it's my opinion only. I feel there's still 1 or 2 rises before we see something come down, basically because of where the market is. It's like that bubble I said before. When you blow up a balloon, it only gets to a certain stage where it'll actually burst. So you're better off blowing that balloon up and releasing the pressure, blowing it up, releasing the pressure. So I think the market, in my opinion, the market's too hot. I think we're going to see some softening. Obviously, all your good tenancies or your good national tenants are still going to be there and still stay strong because they're over a 15-year period. So investors, I suppose, whether they're investing in one area or 3 or 4, people like to diversify a little bit more now, a little bit industrial, maybe a bit in medical, depending on the size of the investment. But these days, people kind of like don't really care with investment. The commercial market is fairly strong. People love that idea of a net return. So we're talking these yields here. They're also obviously net. When you buy a house and you rent a house out, you've got all those expenses you've got to pay. So really in commercial, it's a set and forget. If you've got a good property manager, you sit back and the money just rolls in every month. And then you've just got to worry about when you need a new tenant. But if you plan early enough and you know early enough, you can make those adjustments and get that new tenant in without losing too much.
Sounds like a great problem to have, good paying tenants and a good property manager. So moving on then to leases, how have we seen leases change due to current investment trends that we're seeing? I suppose as shared spaces and subletting becomes more popular, leases are changing to incorporate this. So obviously leases are allowing for tenants to sublease to other tenants to take over the lease, or basically just have a portion of their office, basically taken up by a particular other tenant in conjunction with them. Shared spaces are huge now, like you said before, people not using all of the office space. So they've got, empty parts of the business that they want to basically have subletted to someone else to help relieve some of the costs that they're paying for the tenancy. Also, as I mentioned before, we've got the new Property Law Act, which will come into play next year. This is going to ensure that if the lessee does request these consents to basically assign, sublease, or change the permitted use, and any other alterations that requires the landlord's consent, that the landlord's only going to have 1 month from receiving this necessary notice period to provide a decision. So it's going to be a big change moving into next year. That will be interesting and, give the tenant, I suppose, a little bit more power in terms of those requests. Often with leases, we will see incentives being given to the tenants for them to sign up to leases. Generally, the bigger the lease term, the bigger incentive that's available to the tenant. Incentives can be made up of various different types of incentives. So, the landlord could offer the tenant a rent-free period. So it could be 6 months rent-free for a 5-year lease, for example. Otherwise, they could do it as a bit more of a contribution towards fit-out. So often with tenants, they're going into premises which could be a bare shell or something that's not going to suit their needs, and they're going to spend quite a bit of money in a fit-out. So the landlord will contribute a certain amount of money towards that fit-out. Sometimes the incentive could be mixed as well. They could be giving a rent-free period and a contribution towards the fit-out. Even with the rent-free period, sometimes as well, that'll often be staggered. So we see it sometimes where it's, if it's a 5-year lease, it might be 2 months every year, or it could be 50%, over 12 months, for example. With the incentive deeds, though, often they're not actually included in the lease. They're drafted as a separate document known as the incentive deed. The reason for this is often leases will get registered over the title, which means they're in the public domain and anyone can actually search and see the actual incentive that's been given. So particularly when you've got properties that are, there's various, it's a body corporate, for example, and there's multiple properties within that one set of shops or set of office space, building, whatever, the landlord doesn't want the other potential tenants to know what type of incentive has been given to that particular tenant, because they want to obviously try and negotiate with new incoming tenants as little incentive as they can. And, if they're to make publicly available the incentives, then, that makes it a bit more difficult. The landlord, will keep that basically withheld by putting it in the incentive deed, which then won't be registered on the title. They also, with the incentives, they generally won't pass on as well. So if the lease does get assigned, in the early stages or while that incentive is still available, it's not something that's actually rolled on to the new tenant. And also, if the tenant was in breach of the lease for whatever reason, that incentive deed could be basically clawed back on as well. So landlord needs to make sure that clawback provision is within the incentive deed so that they can do that, because that's generally quite common and what should be the case with those incentive deeds. So we'll move on now to some of the market conditions, Rob, that we're seeing. So I think there's quite a few that we've got listed here.
Yeah, it's interesting circle, this, isn't it?
Up for you if you want to have a chat about some of these ones that we're seeing, quite a few.
I suppose when people say, what does affect market conditions and how does market change? How do we go from one market to another? When you start looking at all the things that will affect it, it's quite massive. It's not just one area, everywhere from supply and demand up in the top left is a big one. That will affect where the market's going to be. Oversupply, price goes down, demand, price goes up. Government debt, our government debt, even though we don't see it here, but it has to play a role. And of course, interest rates from banks, a big one there. Cash rates, which, hook into your interest rates area, government policies, economic growth. If we're growing economically, obviously it's going to help as well. Unemployment's a big one, which leads in with inflation. Building costs is huge at the moment. Building costs go up. We've got wages and wage growth up the top and then wages down the bottom. Economic trade, Australian dollar. You look at all that there, and that's why I love this diagram. You put that in a circle, and not one of these areas really, like, they all contribute, and some a bit less than others, and some more than others. But I think the next slide, did you put that other slide in? I think,
yes, we've got talking about a recession now. So
yeah, recession. Now, what is a recession? A lot of people have this bad thing about recession, is that it's the nasty word. Remember back in '92, Mr. Keating, the famous Mr. Keating, this is the recession we have to have. And it was good, because what it did is it shrunk that bubble and allowed us to grow again. And without having that, we couldn't grow. So like I said earlier, if that bubble keeps going up and up and up, back in 08 or 07, when I was over in the States over there, I got a lot of relatives over there, and they used to spend. And they used to always say to me, America keeps going up. It keeps going up. Land of opportunity. Great. 2008, bang. It was like everything got cut in half, sometimes even more. So recession is when these things get out of whack. So to put it simply, when all these things don't start lining up, our dollar doesn't line up, private and business debt goes out of control, natural resources, we're not supplying enough, government policies aren't there, there's no economic growth, interest rates start going sky high, wages don't keep up with it. So therefore we start seeing unemployment, a lot of things happening. And sometimes recession, as I say, it's like that balloon. Just let the pressure off so that it can then be blown up again. Don't let it burst. So sometimes a recession, I believe we've been in recession a few times over the last few years, but it just doesn't get mentioned. If you don't say it, people don't know. Where it's a nasty word, I look at it differently. It's a good word, because what it does is it allows things to get back into sync again. It's like just lining everything back up and allowing it to grow, instead of everything going all over the place and then eventually just falling in a big heap.
Awesome. So yeah, I suppose then, talking about a recession, obviously we were in one back in 2008. So what do we see the differences then with 2008 compared to where we are now in 2024, Rob?
Well, I think in 23, 24, we're not really, the banks have learned a lot from 08. They learned a lot. They were lending back in 06, because we were going through that massive growth, and they were lending on everything. And then of course we were very lucky in Australia. Our banks held fairly strong, not like America, but they still suffered. So therefore, I suppose the banks don't want that happening again. Once you start to know when something's going to happen, banks start lowering their LVRs. They start seeing the risk. So in other words, they want you putting more skin in the game. Whereas years ago, you could borrow 110% of a house property when you were buying it. So where's the difference? 08 was the stock market had a massive crash, and that was a big driver of it. There's a lot of things that aren't dissimilar. You know what I mean? But I think hopefully we're smart enough now not to see a global crisis. But when you look at it, really the whole globe, I've done a little bit of traveling over the last 6 months, the whole globe is in a bit of, China's buggered. China's really struggling. I've spent 4 weeks over the last 4 months in China, and it is really, 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 really struggling. And they were normally a powerhouse. A lot of countries through Europe struggling big time. So really the whole world is under a lot of economic pressure. Australia, we're very good, solid here. We're a little bit smarter, I think. Our banks are smarter. Maybe less population helps, but at some stage, I don't know. I hope we never hit a crisis or anything like that. We just have to be smart about it, and not blow that balloon up too much.
No, that makes sense. And then back to your favourite topic of yields. A few things for you to talk to us about yields and how they work and things to be aware of, I suppose.
Well, a yield is not determined. It's not an exact figure, is it? A yield is determined by the market, the property, everything. So yields can change. Like I say, return on a property is set. That's your return. That's what you get for it. But yields, when you sell, it's a varying. Yields moving north, and how will they affect your investment property? I think they are now anyway. They're moving very slowly, but good properties are still holding there. But we are seeing them move a little bit. But what we're doing is we're seeing all these varying classes now, like we talked about earlier on, and we're seeing you can't set one yield on commercial property. As you saw with what we talked about earlier, it's different in different areas. So therefore, people are looking for your medical, your industrial and everything like that. And a big thing down the bottom there, southern buyers offering sharper yields, 100%. Years ago, Melbourne, people used to buy on 3.5%, 3%. It was crazy, basically, because lack of stock down there was pushing prices up. The demand was high. While we've got those people from Sydney, Melbourne coming up here buying because they're used to low yields down there, they're the ones that are forcing our yields or keeping our yields fairly strong as well. But that will slow up because our market, I think, now is catching up to Sydney and Melbourne, where we used to lag a lot behind it. Now, we're not the little brother sister anymore. I think we're starting to get pretty well on par.
Awesome. And in terms of yields, like historically, where have they moved over, over the past, 30 years or so?
Look at back in the 90s, Kayleigh. Look at up there, 12%, 10, 12%, all of that sort of thing. And then you saw them come down over time, and you see that big drop there before the GFC. And then obviously the GFC, bang, straight back up again. And then it's taken all those years then for yields to slowly come down. And we saw that obviously in industrial market, they went really, really low straight after COVID. Everyone went back into business, and now they're starting to sneak up a little bit. I've always believed that yields always sit as a general average around that 7%, 6.5%, 7% is a pretty good area for them to sit. If they're too low, you run the risk of if a tenant leaves, your property value can drop. And if they're too high, obviously, the market will go crazy.
And I suppose, we talk about yields, but obviously the interest rates and the lending that the banks are offering, they're going to obviously also impact, the commercial property market. Give some comments on that one.
Yeah, look, everyone has their different approach. And I don't know, I'm surprised there hasn't been a couple of little rate hikes. The main thing is we've got to stem this growth. We've got to stem these prices rising. And obviously it's great for sellers, wanting to sell property. It's fantastic. But as I said earlier, what goes up, it can't keep going up because the average debt now, I think, I haven't looked at it lately, but probably about 6 months ago, the average mortgage was around 750,000, 800,000. And that's ridiculous. If you look at what has to be paid back on a monthly basis, both husband and wife or both partners have to work. And what if one, loses their job or something happens or get very ill? Then it puts a lot of pressure. So years ago, we never had that happening. I still believe, like I said, with that recession slide, I think we need to shrink up a little bit so we can grow bigger. As I said, it's not a bad thing. It's like, there's a graph I used to use years ago, which was like the step graph that goes, you go up and then you have that platform of leveling off, and that solidifies things. Then you go up again and you have that level of that platform again you jump on. Every time you go up a platform, if you fall back down, you only fall to the platform below, don't you? But if you have the pyramid going up and the prices go up and up and up, if you get to the top and something happens, you're going to slide all the way down the bottom. So that's why we need this stairs approach. We need this up, keep things nice and level, go up again, level. So instead of these sharp increases, I like to see steps. If we do that, then we'll always have continual growth.
Yeah, makes sense. I suppose some other things to think about with lending. So how do you think we're positioned? Do we learn anything after the GFC?
Yeah, we did. Banks are smarter. When they start to see things happening, as I said earlier, they start lowering those LVRs. So they make it harder for people to lend. You've got to put in more security. You've got to put more money in. So therefore, if everything keeps secure, then I don't know whether everyone out there understands the term margin calling. Back, up the GFC, banks were calling in loans. Your property prices dropped 20%, 30%. So therefore, we need you to top up another $100,000 or $200,000 on your loan, so that we've still got it sitting at 75, 80%. We haven't seen that to a degree. I believe out in the West, it's happened a little bit with the margin calling about 6 or 12 months ago, and it's good if banks keep a control and a tight rein on it, especially with the LVRs. Then we won't have this pyramid effect where we just slide off the top. We want to try and keep ourselves fairly solid. So it's good to spend, it's good to invest, but invest wisely. Make sure that you keep something for a rainy day. If you buy a property where your tenant's got, say, 3 years left to run on a lease, and let's say they're paying, for meter. If you lose that tenant, make sure you can cover yourself for 6 months. You might get it rented straight away. If the leasing rates drop, make sure you can cover it 400, not 450. So if you always leave that buffer in there, like the banks do, then won't have a problem. And I think 08 helped us learn a lot from that. I think we've got a lot wiser and a lot smarter.
Awesome. Thank you very much, Rob. So obviously some good tips there in terms of, where the current rental market is at, what we're seeing as potentially some of the growth areas in Brisbane and the surrounding areas, and obviously, where the yields currently have been historically and where you think they're going. So yeah, really appreciate your time and taking us through some of those key market updates, and hopefully everyone's learned a few things. I'll probably give it a minute and just see if there's any questions. If you want to take yourself off mute or pop them in the chat bar for us. If there's no questions, we might end it there. But yeah, appreciate your time, Robert. So thank you very much for joining us and providing all your knowledgeable insights to where we are with the market currently and where you see it's heading.
No worries, Kayleigh. A pleasure.
Thank you, everyone. Have a good afternoon. See you later. Thank you for tuning in to another episode of Property Power Talks. We hope you found today's insights valuable and engaging. If you enjoyed the show, don't forget to subscribe and leave us a review. For more information or to connect with our expert team at MB Property Law, then please visit our website at noborderslawgroup.com.au. We look forward to having you join us next time for more expert advice and actionable strategies to master the world of property law. Until then, stay informed and stay empowered.